When people who raise money talk about how they're helping you get financial freedom. No, they're trying to get financial freedom. The truth is, we're offering you a tax awesome investment. We're offering you a double-digit yield, and we want to be your partner forever. Because that they could possibly deliver on. They cannot deliver on financial freedom. If they think you're going to 10x your money through syndication, that's illogical.
Josh, thanks so much for joining me today.
Couldn't be happier, buddy. It's great to get to know you, Joe, because I've been following Invest Clearly now for a couple of years. So I'm excited to dig in and get to know you. I haven't met you before.
Well, likewise, as we were mentioning a little bit earlier, you've talked to a lot of folks from your org, haven't had the opportunity to meet you, and it's a pleasure. So, and I'm looking forward to the listeners hearing a little bit more about you guys, those who don't know. And just in case people don't know about Accountable Equity, I'd love to have you just start off with a brief introduction.
Yeah, so Accountable Equity is the outgrowth of a mission of love, I would say, and we put the name Accountable Equity in there for a meaning. A couple of years ago, I don't know, maybe I'm right, maybe I'm wrong, but I always say, make the name the mission. That way you don't have to write a long mission statement, right? So Accountable Equity was the theory of somewhat tracks my journey. My journey was a hardworking, operational person for high net worth people, helped build a now famous resort operational business in the Northeast of America. And that was one investor, high net worth. And during that same time, I kept being introduced to the idea of syndication, which I'd never heard before. And I kept being surprised that the benefits of those high net worth families, in this case, I had one high net worth family. I was the president. They were the CEO owner. And we're building out this beautiful portfolio, making tremendous value creation with them and for them. And I saw the tax benefits. I saw the ability to use leverage to create, equity recapitalization without sale. All these things the ultra high net worth know how to do, kind of lock, stock, and barrel. And I thought, and once I was introduced to the idea that regular middle class families like myself could own a piece of that if we were accredited, get all the same benefits, I found that to be a sidecar mission in life, is to transfer all that mega strategy and benefit to all of us at a much smaller incremental investment level. And by the way, it's passive. So Accountable Equity is a community of investors. We call it 450, actually 461 investors today, about 5,000 accredited investors, families follow us and are waiting for the deal. We don't offer that many deals, so they're waiting for deals.
Right. That's, as we were speaking about earlier, my family's in hotels, and it seems like from the outside, owning passively is the right way to do it. So I want to dig into this a little bit. Now, first off, let me just say, obviously at Invest Clearly, we believe in making the name the mission.
That's true.
That's what we're trying to do also, right? Bring clarity to that space. But I want to talk a little bit about how you navigate, or like how kind of moving from working with one super wealthy individual and kind of like managing their portfolio, like how that's translated. Obviously you had to go out, you had to find investors, but how has that informed that journey in terms of communicating with your investors?
Sure. And communication is a key word for your business, and we love it too. So the transition, I think we had an unfair advantage, Joe. One, there's something happened when we were building the resort business for the high net worth family, a famous regional business called Icona, Icona. Look it up. It's won all kinds of awards, and it was the biggest honor of my life to be the president and partner. Well, that was originally a real estate opportunity for that family office. And for me too, I thought, you do real estate repositioning, and real estate repositioning has all those tax benefits and wealth creation. Well, something changed because hospitality is profoundly not passive for the people who operate it or own it.
Right.
And my heart just had my wife says it caught on fire about 15 years ago now, when things didn't go well in that first year with that big business. It went badly, and we realized how intimate hospitality was. And I'll tell that story in a minute, but that unfair advantage is that my whole career in real estate, after I got done building beautiful buildings and then working on this portfolio of hospitality buildings, was oriented around hospitality, and hospitality is ultimately communication oriented, right? And relationship oriented. So when we went into the world of capital formation and creating capital vehicles for families, it's almost like communication is and hospitality is embedded, right?
Yeah.
And that's why the name is the mission. And we do annual free conferences for our investors where we actually offer them hospitality, right? We say, come see your properties. And we call those learn and grow. So hospitality as a form of communication was a little bit of an unfair advantage for us, I think. And that's partially why people enjoy both. They like the real estate underlying asset, but then they start to like the community. And as far as communication, I can dig in on whatever you want me to dig in on.
Yeah, well, you kind of just stole one of my questions. So I was going to ask how being in hospitality impacts your investor communication strategy, but I think that's an observation I was making leading into this conversation is like you do kind of have an unfair advantage. I mean, to keep guests coming back and getting good reviews from them, you have to have service. So you're saying that does translate really.
It translates. And the practical ways, and I was writing this one time for the website. I'm not sure if it made it on the website. I said, well, look, at the basis of it, we use the modern method of direct communication through social posts. And so I imagine I probably make a social post almost every single week religiously on one or more of the real estate assets. Not necessarily just deal alerts like, hey, come invest with us. As a matter of fact, we're not typically raising money except for, we have vehicles for families that we're like a two-way street. Sometimes we're raising money because we're trying to buy a property. Other times we're raising money. We have vehicles set up that are super powerful for the families that allow us to offset using banks. So instead of borrowing from a bank, we borrow from some lines of credit with our own investors. And so they get the money instead of the banks. Other times we do a leasing company where instead of us leasing from Bank of America for all the kitchen equipment and tractors, we'll create a leasing company once a year and let investors buy that leasing company. They get all the tax savings, right? We still have to pay the same money anyway. And so we do these types of things. I think it's a way to keep our investors engaged because we don't go out willy-nilly and buy real estate.
Right.
We make strategic purchases. And so in order to keep the community satisfied on some, each year they have some tax strategy needs. We were going to borrow the money anyway to buy that tractor. So we have all kinds of ways. And then we have capital participation funds. So yeah, as far as communication, there's always going to be a regular social post. Follow me. There's always going to be a podcast released every week. Not necessarily about the properties, but staying in communication with me in that way. We have a nice, robust investor relations group, all run by investors. Every one of them is a multi-$100,000 investor, not a $10,000 investor. And they run the whole communication program. Actually, some of them left their other jobs to come join us full time. And then we do conferences every year.
Yeah, I've talked to some of your team. I think that's a unique thing about your organization.
Yeah, they're real investors, right?
Yeah, they are real investors. And they believe in what you guys are doing. I also think one of the interesting things you just said there that I had spoken to some folks about your firm, and I think is one of the things we hear people talking about just in the ecosystem in general. If the deals aren't happening all the time, like how do you've got your LPs and they're engaged with you, but like if you don't have anything to offer them, they want to deploy capital, they might not, they're going to get engaged with someone else in that moment. And you guys seems like you're really designing products to help the LPs kind of achieve their goals consistently throughout the years. Is that, how does it feed into your broader vision of how you serve the LP?
You know what? Yeah. Thank you for asking that. So a lot of times when I first explained this, Joe, years ago in 2018, when I first learned that regular people could own assets like this, and I, of course, am a regular people. So I was excited to be in this world as an avatar of this world. I mean, this is what I would have needed if I wasn't an operator. So, yeah, my train of thought there for a second was the reason we do those other vehicles is, one, it was necessity at first, and we were super transparent. So when we were building this company, a couple misunderstandings at first were, I was coming from a high net worth backed business. We were happy to be hardworking, hustling, operational entrepreneurs. And so then we go and raise money from retail investors. We buy properties that are pennies on the dollar. We are major value add buyers usually, right? So we know we're buying something below. I think our first asset we bought as a group, Renault Winery, I think we might have bought it below the value of the land because it was a historic property that was owned by a bank, and we were able to take it off their hands before they had to close it. And it was more of a PR thing for them to get it off their hands. So we bought it, I think, below value of dirt. But then that means we had to spend millions and millions of dollars to make it not crap, right? Well, guess what? One miscalculation right from the beginning was, if you do well from an operating business point of view, I thought the banks and other lenders would participate. But early on, it became very challenging to find lenders other than construction lenders to support us because we were so radically improving the value. And I'll just give you the top line. Now there's a bottom line, but the top line went from a purchase of $5 million to a valuation today of $54 million. So you're like, shnikes, that's a home run. Well, the underlying issues that were miscalculated at first were I couldn't get good debt for about 4 years.
Right.
Because they couldn't believe the model was working. Right. When a banker takes a portfolio piece and they say, well, let me look at your, the track record. Well, the reason it went into bankruptcy is because the last owner owned it for 40 years and ran it into the ground. So his numbers didn't look good. Then the bank owned it. Their numbers didn't look very good.
Right.
And then I bought it and started fixing it up and my numbers didn't look good. So they're like, we don't believe you. But appraisers were coming in and seeing all the sales we were making, the contract weddings. They were seeing the beauty of the property. And they're starting to give us valuations originally like 20 million. Then they were giving us valuations the next year at 30 million. And it kind of stalled out in the 30s for a while. Now, all of a sudden, it popped up to 54. So my point is, banks didn't know how to participate. So therein lies the necessity of raising lines of credit / leasing product company lines of credit from direct retail investors. So necessity, banks aren't that excited about us until we have a 5-year track record. Investors are excited. They get to see the tangible assets. They get all the IRS benefits. Boom. Magic happened.
Interesting. So like fasting forward.
Yeah, either way. Be kind, rewind, brother. Be kind.
Exactly. So started on necessity. Today, like, where does it fit into? I think we should probably pause and talk a little bit about like why you do what you do, right? But like, where does it fit into like your, like, if you had a mission statement for what you're trying to do, not necessarily from the company perspective, but like to the LPs.
Yeah, to the LPs. So we're on the 7th leasing fund. Okay, turns out these were tremendously powerful for the investors. Now I can sign leasing contracts now because we have a long track record and everybody will give me a leasing contract now. But at first it was harder to get. So it's no longer a necessity, but it is extremely in high demand. Last year the thing sold out in 5 days, and it's because it really fulfills the passive loss benefit of the bonus depreciation. And because we have to pay you every month, it takes a lot of the risk out for the investor. They feel great. They're getting their money back with yield really quickly. Large monthly checks. It's not like you put $100,000 in and you get $50. You get like $1,000, $1,900. You get a lot of money every month, right? And what we're doing is returning basically it's like a lease. You're getting paid down and you're getting your yield. So you don't do it to get rich off the flow, because you're not. I mean, the biggest yield we'll give you is 8%. Okay. But the reason you're doing it is because he wrote us a $100,000 check in 25. Now we're doing one right this minute. And you're going to get a negative $100,000 in 25.
Right.
And so if you can benefit from that, not everybody can, by the way, and we're pretty honest about that. And we say, talk to your CPA. But if you can take the passive loss, that could be upwards of a $30,000+ tax savings, depending on what your situation is. Oh, and by the way, you're still going to make money on your money.
Right.
So you can see why people love it. I always say this is why Bank of America does leases.
Right. Of course.
It's opportunistic for them, and we're making it available to you. So that one, it's popular demand. The debt fund, the reason we do that, and we'll probably always have some version of it open, is because a lot of people use their IRA to invest with us. And people have flow through their IRAs, those self-directed IRAs, where, they sold a building. All of a sudden now they have $200,000 sitting in it, or maybe they have $45,000 sitting in it. And what are they going to do with it? They're going to wait for their next investment. So we came up with something that said, sure, you can leave it there, or you could put it with us, which will offset us having to use other lines of credit. And the good news is you can, in the future, we came up with something cool. You'll love this, Joe. Kind of like Invest Clearly. We named it the EROA. So the EROA, rollover. So the equity rollover, right? Rollover, EROA, something like that. Now I'm forgetting the acronym, but you can roll it over to equity. So yes, I can't roll it over to equity in somebody else's deal, but each year and a half we've been finding a deal, and we created a mechanism where they can roll it into long-term perpetual equity in a deal, which means they've never wasted time with their money in the IRA, if you get my point.
Yeah, totally get it. It's an interesting strategy. I'm sure I know you get a lot of interest because, like I said, I've talked to your folks about it. And I think there clearly is appetite for these depreciation oriented funds, as we've seen it in other funds that didn't work out so well, not yours, clearly. But so let's circle back to there's two things I want to make sure we get to. One, like the why you do what you do. Do you feel like
I really want to share that, Joe, because this is mostly why we attract investors. And sometimes we probably repel investors, Joe. And we think for the long-term health of the community and all that, it's okay to attract and to repel at the same time. Sure. So at the heart of all this was a calling or mission I felt called to from early 2010s till now, and that was to make hospitality live up to its original mission, meaning the dawn of civilization. Hospitality is a ministry. And what do I mean by ministry? Because I have people, we now employ hundreds and hundreds of people, which is also a contrarian thing, right, Joe? Because everybody says use AI and don't hire anybody. And that is absolutely smart. But in my business, it's kind of opportunistic. We get to hire people, and it's actually core to what we do is hire people. And the nice thing about that is there's a lot of people out there that want to make good money. They want the full tax benefits of using the IRS code, and they want to give people positive life impact. And, last year we had over 700 people get a W-2 stub from us at the end of the year. Now, I say that because that means there was never 700 people employed at one time, but through seasonal surges, there were 700 people showed up to work once. And we try to do a culture called Viva, and that's the name of our hospitality business, and it means to revive the soul. And we say, well, what souls are you talking about, Josh? We say the soul of the property usually comes visually like a revival of the property typically is what you think. The story. What's the story of this property? What's the soul? Number 2 is the team. And number 3, of course, is the souls of the guests when they show up. And we use the word soul on purpose because, one, I took it from the old ancient logs of captains. When they took a cruise across the open ocean, they would say how many souls on board. Airplanes used to say how many souls on board. And I think it shows the dignity of a person to call them more than just a person, even just they have something that makes us all equal, our souls. And it also reminds us how important our work is. And by giving that purpose of life to the children that are 18 that work with us, or 16, sometimes you can start with us, or how about the 65-year-old bartender who finds this to be their life's work? And I want them to feel dignified. We want the kid that hasn't had a job yet, the person who's a world-class bartender or a world-class chef, or even just, I have a head of stewarding, Joe. I mean, in our businesses, they're so robust. There's something called the stewarding department, which I didn't even know about until we grew these businesses so big. It's the proper terminology of a dishwasher. And it means they're there to steward the physical assets, glasses and platewares. You can imagine, Joe, in our business, we have over $1 million worth of plates and glasses and dishes and silverware. And so they're stewarding that. And You know how easy it is to lose a rack of glasses and you just lost $78 or, at the cheapest end, or $250 at the highest end. So you're like, geez, goodness gracious, that was just an accident because they dropped the rack, right?
Right.
So stewarding is this beautiful sense of place. Anyway, so we have people at all different levels, and we want them to feel their dignity. And the last thing is, so Viva May, and this has been famous on 100 podcasts probably now, other people's shows, we talk about the 3 virtues of Viva May. And these are the ancient virtues of hospitality. I don't think we created them. We just live by them. One, this goes to ancient Chinese proverb, a man without a smile should not open a shop. So the first principle of hospitality is you have to have joy of service. I always say, good news, we'll teach you how to carry the plate and make a delicious cocktail, but you actually have to want to love on somebody. I can't make you do that. You actually have to enjoy this, okay? So we only hire for joy of service, and good news is most people actually do have that. And then the second virtue is humility. And what do you say? You got to be wanting to grow in humility. You're not actually humble. Nobody is. You're not actually great at it, but you have to want to get a little better in humility, which is seeing the dignity of others. And then the third one is ministry, and I've said it a few times, but I say the third one is let's dare to make our work a ministry. And what does that mean? It means when you're delivering the food to the table, it's a task. But when you're delivering the food to the table to show love or make it a gift, it's spiritual. But guess what? It's the same amount of physical steps, the same work. Usually one has an impact and one doesn't. So we want to have positive impacts on these guests and a lot of stuff there. So that's the core to why we do what we do. And then it permeates accountable equity. And we try to attract investors that realize how much they're doing for this world by investing in these types of major regional resorts. It's not just 10 people showing up on a day. It can be 2,000 people in a day. It can be 150, but it can be 2,000 in a day.
I feel like I could ask you a couple hours worth of questions regarding what you just told me. In the spirit of time, we're not going to get into that. That's really helpful, though, to understand. I think, I'm sure that comes through all of your LP conversations, just in terms of like, hey, when you're joining us, you're joining something this is bigger. Like you think about your business as something bigger. I think that definitely just came through. Not to do like a hard pivot, but I think it is related.
Do a hard pivot.
I think it is related. Like, it sounds like in general, obviously you came out of like having a ton of experience already building a hospitality brand for somebody who like theoretically had some room for cushion. Like you miss a number, it's not great. You have to have that conversation, but it's not the end of the world. Like there's an expectation there that things can go wrong. Anybody who's attained a lot of wealth kind of knows that. A little bit different sometimes with accredited investors. They throw a couple $100,000 at you, like something misses, it feels like a bigger deal for them. Are there any examples, in your journey here where you've communicated something? This podcast is all about trust, right? And transparency and communication. Sounds like that's core to your org. But I'd love to understand like a moment where something maybe didn't exactly like you thought it would, and you had to how did you communicate it? How did you deal with it?
Well, there's two. One I did better than the other. I've already shared the one that I misunderstood how financing would work in a value add business. I really did think if you just sold a lot of weddings and show that your revenue went from 2 million to 4 million to 17 million, I thought that would help banks say, okay, we'll give you some real loans. And, today it's over 25, but at one property. I was wrong. So I've already told you that, and my investors have heard that two things went wrong. This is not even, I'm going to give you 3 examples. I'm just going to finish this. The early years were also overlapping with COVID. Now, nobody wants to talk about COVID. The COVID's over. It was a big pain in the ass to most businesses. Yeah. But it feels like it had disproportionate pressure on debt. It really removed a lot of debt providers from my industry. Yeah. You can imagine why, right? Hotels shut down sometimes for a year, and bank loans had to be postponed, and all kinds of bad things happened, right, to hospitality during 20 and 21. Well, thankfully, we actually grew, but we're part of the hospitality category, so most banks wouldn't even talk to me. All right, that's over. Hopefully, we're at the end of that cycle. I'm having much better conversations now. But the next major mistake, which was a true mistake, well, it's not even chronological. There was a mistake this last year. And no, I have not communicated this well. So feel free to, we'll use this. I mean, I've said it, but I haven't articulated it well. One is we got into the spa business this year, and I had postponed doing spas for years because, most hotels that put a spa on don't make money with the spa. That was what I was told. It was anecdotal evidence from a few investor groups that I was friends with. And so we do the spa past a year and a half ago, and we put in a third-party management group to run that spa and launch that spa. So when we put that third-party operator in, I totally made a mistake. One, I fell in love with the culture of the person who came and presented to us. Her name was Julia Sutton, lovely lady. And then she disappeared from the project because she got tragically killed in a car accident, which is just unbelievably heart-wrenching. Clearly, without her and her leadership, I think it kind of broke down the relationship. And then we failed to execute on the permitting process. And the two things came together where we actually had to make a pivot and go to a new operational partner. And that will have a drag for a year on profitability. So that's one that I think we're in a much better spot, but boy, was that a mistake. And we did the second one, not necessarily in chronological order, was a spa, launching a spa. And the communication to the investors was in 24, we started talking about it. I'm sorry, it was in 23 we might have started talking about it. 24, we raised money. And I will say the first challenge was the money didn't come in right. It didn't come in when we thought it would come in the summer of 24. And of course, there was a big famous election going on. And they do say a lot of things went wrong in that summer. So we ended up having a slow construction anyway, but because we had to wait for the capital. But simultaneously, we were struggling tremendously with the permits. The long story, but we were struggling to get them. We had been promised them, but then when we went back in, our structural stuff was off and the lag time was too long. And then the third mistake related to that spa was we signed up with an operational team. And I don't know if we did enough homework on them. We loved the person that we were working with. Really great person, great experience, kind of a thought leader in the industry with really good background. Brought their management company in, but she didn't own the management company anymore. She had sold it, and we didn't dig in on that. We didn't dig on what were the consequences of the person we want to work with not owning it. Well, I had many conversations with her, and she kept saying, don't worry, it'll be me that you work with as you launch and create this brand, and we'll be the staffing of it. Well, 2 months later after signing the contract, she does get tragically run over at a hit and run early in the morning when she's out jogging. I mean, talk about that's shockingly tragic. She doesn't have cancer. She's healthy. She hit and run, passes away. I go to her funeral, and I don't quite recognize the gravity of the ramifications for us, but it just did not go well from that point forward, executing through operators that weren't her. Well, I take half the blame. They should take half the blame. Anyway, in the end, we end up having to break up, and now we did find a new operator. Well, through that process, our structure is it's not like our investors are eager to see every detail. That's why I always say we do have the constant flow of communication through, of course, all of our properties are public 365 days a year. You could check in and see how we're doing. You could come right up to my offices. So there's really no hiding. It's not like we're doing this in Siberia. It's pretty much available to anybody. But we don't go into the details day to day. And so this one I did not communicate much on until recently. And I'm not sure what the benefit would have been to communicate on this. I mean, we had to operationally fix it, which we did. We went to market, found a new group. Turns out we feel much better about them. Much more homework was done. And we are opening the spa as we speak. By the time you release this, spa will be open. And things just went from going painful for a year, somewhat because of they didn't have much depth behind the person we wanted to work with.
Right.
And now the group we have does have depth. So that's one thing we didn't communicate well with. And then the other one, I think we did communicate well with, the bad news. And that was this past year, 24, we had been working hard to make preference payments on our equity partnerships, right? So over at the debt fund or the line of credit fund, I'll call it, and then the leasing companies never missed a payment. Obviously, they're good. We're just making their monthly payments right out of cash flow because that's what we are. We're leasing equipment. But over in the equity funds, these are long-term wealth building funds. These are meant to be recapitalized.
Sure.
One mistake was we've been paying the preference payments from day one, year two, I guess, on. Now, the challenge with that was these were mega turnarounds. And I should have probably, even though we had cash, I probably should have been more conservative in making those distributions early on. So it just kept us in a very tight cash position every year. And we were growing at double digits every year. Those were miscalculations on my part, is that if you're going to offer a fund, and we'll fix this in future funds, if you're going to offer a fund that's going to transform the value of something and not just operate it better, then depleting cash out of the company in the first 2 years is hurting the ultimate goal of recapitalization.
Right.
And I guess I didn't quite calculate that correctly. So this past year, 24, we had to have a webinar and explain that we stepped back from that policy. We're going to do, I'll call it a functional 1% distribution to everybody so that everybody knows we're not going anywhere. And we took, instead of doing the full distributions and preference payments, we did a 1%. It went really well. For most people, it took that great because they also knew that the other, hard news was we had ridden the wave of really rapid growth from post-COVID. And that in 23 going into 24, that was the first time there had been a plateauing and a dip on the businesses we were in, which were weddings and outdoor events, right? So those two things we do very well. We were surging during the COVID and the 3 years after. 24 is where we finally felt a holdback. So we disclosed that we, for the first time ever, stepped back. Also going to do a smaller pref payments. And honestly, I think because of the trust we've built, it went quite well, but those were some tough communications. And then, of course, follow-up calls with certain people.
Sure.
The good news is, of course, it is nice to have a silver lining. Thank God I can say it, is that we're actually far better now cycling in through 25 than we were in 24. So we look like we're doing back onto the pro forma, but we did have a step back and we did make some changes. And those were tough conversations, but you do the right thing and you make it clear for everybody.
Well, it seems like, again, with your ethos being kind of like just generally the care for people, I haven't seen the communications myself, but it stands to reason that a lot of your LPs see you as a genuine partner. And so I think there's a difference in terms of cadence of communication or relationships you build with people. We have to deliver bad news, but, my business partners come to me and say, hey, we need to do this hard thing. It's not that big of a deal. Where I think what people get caught in this is when they're kind of distant anyway, they're not really communicating. And then they evaporate when things are going wrong. And that seems to be, when we look at the reviews, that seems to be where people get that, where LPs get really upset. It's just like, okay, this person communicated really well with me when they needed my money. And then they basically stopped communicating with me. And then things were going wrong and they didn't communicate with me. You almost never see people say, hey, this person's communicating really well. Things are going wrong. And slow down. That people know they get these things and there's some risk associated of that sort of.
Well, Joe, you brought up an interesting point. So I can live on both sides of this as an investor. Obviously, I'm the largest investor in our own company as well. But think about that cycle you just said, Joe, which was the fundraiser was good at raising money and communicating, but then not good when it goes bad. There's probably two logical explanations for that. One, I was such a contrarian 6, 7, 8 years ago when we created an entity to be the private equity shop and an entity to run the day-to-day of what a hotel is. And we knew that we were doing something different compared to like 20 or 30 out of my competitors at the time who were buying multifamily or self-storage. And a lot of times they just kind of blended it all. And I said, well, think about what you're doing. The day you raise money to buy real estate, you're in two businesses.
Right.
You tell everybody you're good at running real estate. Maybe you are. Maybe you're the best at not only the assumptions, the lease out, whatever it would be. You might be great at that. Then you raise $1 and you're in a different industry, and it's called investor relations, private equity, and capital formation. And it was so clear to me that we were in two businesses. And now we went to the extreme on that. We gave it its a brand. We gave it an ethos. We do the conferences on purpose so that people meet and mingle, and that we add value on different levels, not just returns.
Yeah.
But we also recognized that we would have to invest in that business having staff,
Right.
having proper third-party reviews, having CPAs, strategists that help us build the funds, and lawyers.
Sure. Yeah.
A lot of people didn't give enough credit to the fact that they were raising money. Do you get my point, Joe? They thought of it as I was buying a building.
It's a means to
different.
an end. They're using it as a means to an end rather than like you're recognizing it for what it is. Like, hey, this is people who are trusting me with, in some cases, like larger portions than maybe we're even comfortable with of their life savings. And that deserves its own kind of dedicated kind of care and focus, not just, hey, you get your checks, you should be happy kind of thing. Yeah. All right. We've gone super long and you've been generous with your time. I want to ask you one more question and then give you an opportunity to let people know where to find you. So the question we ask everyone is, what part of passive investing needs to die? So what out there? Yeah. You get the question.
Actually, I'll tell you, here's one. I give this speech all the time. I do not think people should assume that passive investing is a financial freedom choice, unless they're starting with multiple millions of dollars and they live below their means. What do I mean by that? When this blows my mind when people who raise money talk about how they're helping you get financial freedom. No, they're trying to get financial freedom. What they should be saying, the truth is, we're offering you a tax awesome investment. We're offering you a double-digit yield, and we want to be your partner forever. Because that they could possibly deliver on.
Right.
They cannot deliver on financial freedom. And so when I meet investors sometimes that are legitimately capable people that want to build an empire, I tell them this isn't the right investment for them.
Right.
Because if you need that $100,000 to go build an empire, you will make more if you build a business. You'll make more on your $100,000 that you manage, building out a company or buying your own property, than any syndication could ever offer you, because by definition, a syndication shouldn't be offering expected returns more than 15 to 20%, maybe not even 20%, because there's something they're missing in their underwriting.
Right.
So if they think you're going to, 10x your money through syndication, that's illogical.
Right.
So please kill the idea of financial freedom from investing passively.
Yeah.
Go ahead and create financial freedom by building a massive nest egg and then using that to get cash flow. But right. I do think the other way around is probably not logical.
Yeah, no, I can't improve on that at all. That's a good word. Okay, so if folks want to find you, want to learn more about Accountable Equity, what do they do?
Yeah, just the name is the mission and the URL. How about that, Joe? Just like you.
Yeah.
Just type in 2 words together, accountableequity.com.
Perfect. All right. Well, thanks so much, Josh. Really appreciate it. And
thank you, Joe. Right. We appreciate you, buddy.